What if you could learn the secrets of investing from the man who's turned thousands into billions? Warren Buffett, often called the Oracle of Omaha, is one of the most successful investors of all time. For nearly 50 years, he's been running Berkshire Hathaway, a massive holding company with ownership in over 60 businesses, including well-known names like Geico and Dairy Queen. His investment decisions have consistently outperformed the market, and he's built a fortune worth billions. So, what's his secret? Buffett's approach to investing is surprisingly straightforward. He focuses on long-term growth rather than short-term gains. Instead of trying to predict where the market will go next, Buffett looks for solid businesses with strong fundamentals. He invests in companies he understands and believes in, holding on to them for decades. He doesn't jump at every new trend. Instead, he waits patiently for the right opportunities. One of the key ideas behind this strategy is the concept of value investing. This means he seeks out stocks that are priced lower than their true worth. By buying undervalued companies and holding on to them, he's able to build wealth over time, regardless of market ups and downs. Buffett's philosophy is simple. Invest in good businesses, be patient, and don't let emotions drive decisions. Let's dive into how he applies these principles to master the market. Chapter 1. Economic Predictions. Why Buffett ignores them. When it comes to investing, most people rely on economic predictions to decide when to buy or sell. But Warren Buffett does the exact opposite. He completely ignores market forecasts and doesn't try to time the market at all. Why? Because he believes economic predictions are too uncertain and often unreliable. Instead of guessing what the market will do next, Buffett focuses on the present and looks at the health of individual businesses. Buffett has often said that he doesn't know anyone who has successfully predicted the economy's future consistently. He's seen experts fail time and again, so he doesn't waste time listening to predictions. Even during economic events like recessions, Buffett stays calm and sticks to his long-term strategy. For him, market swings are just part of the journey. In fact, Buffett's partner, Charlie Munger, once said they've never made an investment decision based on economic forecast. Instead, they look at a business's fundamentals, its products, management, and financial health. This allows them to stay confident, regardless of what's happening in the economy. So, if you're thinking of following Buffett's lead, start by focusing on the business itself and stop worrying about where the market might be headed next. Chapter 2. The Importance of Cash Reserves and Risk Management. Warren Buffett always emphasizes the importance of having cash on hand. He believes that cash acts as a fortress for both individual investors and large companies like Berkshire Hathaway. For him, cash isn't just money sitting around, it's security and flexibility. Having a solid cash reserve means being prepared for unexpected opportunities or setbacks. Whether it's an economic downturn or a chance to buy stocks at a bargain, cash gives you the power to act when the time is right. Buffett often points out that Berkshire keeps over $100 billion in cash. Why? Because he wants to make sure the company can handle any situation, like a major natural disaster or a sudden market crash. This same principle applies to individual investors. If you rely on a paycheck to cover expenses, having cash reserves is crucial to avoid financial stress. But how much cash should you keep? Buffett says it depends on your situation. If you've paid off your debts and have stable investments, you might not need much. But if you have ongoing expenses, a solid emergency fund can give you peace of mind. So, following Buffett's advice means being ready for anything and staying flexible with cash when opportunities arise. Chapter 3. Investing in Quality Businesses. The Apple Case Study. One of Warren Buffett's most talked about investments is his stake in Apple. Though he was initially hesitant about tech stocks, Buffett ultimately saw Apple as more than just a tech company. He recognized it as a strong, reliable business with a loyal customer base and consistent profitability. For Buffett, investing in Apple was like buying into a company he could understand, one with a product that people truly valued. Buffett doesn't focus on every little move Apple makes. Instead, he looks at the bigger picture. He often compares investing to buying you don't need to check on it daily to know it's valuable. The same goes for his investments. Buffett believes in buying businesses he can hold on to for years, even decades, because he trusts their long-term potential. This patience and confidence allows him to ignore short-term stock fluctuations and focus on steady growth. By investing in Apple, Buffett showed that he values strong brands with proven track records. He's not interested in buying the next hot startup or following trends. Instead, he picks companies that have already shown that they can perform well over time. Apple's consistent revenue, its reputation for innovation, and its massive customer loyalty made it a perfect fit for his portfolio. Buffett's investment in Apple demonstrates his key strategy: buy quality businesses with staying power. He's not looking for quick gains. He's investing in companies that will be around for the long haul. So when choosing stocks, think like Buffett. Focus on quality, stability, and long-term potential. Chapter 4. Buffett's view on stock buybacks and market manipulation. Stock buybacks are often a hot topic in investing, and Warren Buffett has a clear stance on them. He believes that buybacks can be a smart way to return value to shareholders, but only when the stock is undervalued. For Buffett, a buyback makes sense if the company's shares are trading for less than their intrinsic worth. In this way, buybacks can be a tool to strengthen the company's value, benefiting all shareholders. However, Buffett is aware of the controversy surrounding buybacks, especially with some calling for government regulation to control them. He argues that as long as buybacks are done responsibly, they're just another way for companies to manage their capital. Buffett has even conducted buybacks at Berkshire Hathaway when he felt the stock was undervalued, showing he practices what he preaches. Buffett dismisses the idea that buybacks are inherently harmful or manipulative. He points out that, like dividends, buybacks are simply a method for companies to distribute excess cash to their shareholders. While there will always be some misuse in any financial tool, he believes buybacks, when used responsibly, are beneficial. In Buffett's view, responsible buybacks align with long-term investing principles. They're a way to invest back into the company, provided the price is right, and it serves the interests of the shareholders. For him, it's all about creating value over the long haul. Chapter 5. Avoiding speculation and focusing on core competence. Warren Buffett is famous for sticking to what he knows best. He often talks about staying within his circle of competence, which means he only invests in businesses he truly understands. This approach helps him avoid speculative investments and risky trends. For example, even though he admires companies like Amazon and Microsoft, he avoided investing in them for years because he didn't feel confident in his ability to evaluate them fully. Buffett believes that trying to invest outside your expertise can lead to mistakes. He emphasizes that you don't need to understand every sector or jump into the latest trends to be successful. Instead, he advises focusing on companies that you can analyze with confidence. By sticking to areas where you have knowledge and insight, you can make more informed decisions and avoid unnecessary risks. This approach is all about long-term stability. Buffett isn't concerned about missing out on flashy tech stocks or fast-moving industries. He's more interested in building a portfolio filled with dependable, well-understood businesses. For him, the key to success is knowing his limits and only investing where he feels comfortable. Buffett's advice here is simple. Avoid speculation, stay within your area of expertise, and focus on businesses you can truly understand. It's a strategy that's helped him achieve remarkable success, and it's one that any investor can follow. Chapter 6. The Role of Corporate and Federal Debt in Market Dynamics. Warren Buffett keeps a close eye on debt. both at the corporate and federal levels. He believes that debt can impact a company's long-term stability, making it a key factor in his investment decisions. For Buffett, taking on debt isn't always a bad thing, but it needs to be managed carefully. He looks for companies that handle their debt responsibly and avoid over-leveraging themselves, as excessive debt can put a business at risk during tough economic times. When it comes to federal debt, Buffett has noted that the US government's rising debt is unusual, especially given the low interest rates and minimal inflation seen in recent years. He acknowledges that while high debt levels haven't yet led to major problems, they could become concerning in the future. Buffett's stance on debt underscores the importance of understanding a company's financial health. For him, a strong balance sheet with manageable debt levels is a crucial part for mastering the market. Chapter 7. Buffett's Thoughts on Economic and Social Responsibility. Warren Buffett is not only focused on financial success, but also cares deeply about social responsibility. He believes that in a prosperous country like the United States, no one should be left behind. One way he supports this idea is by advocating for the Earned Income Tax Credit, which helps low-income workers receive additional income. Buffett sees this as a fair way to assist people who might not benefit as much from the traditional market system. Buffett also emphasizes the importance of giving back. He's pledged to donate most of his wealth to charity, reflecting his belief that those who've been fortunate have a duty to help others. He argues that a strong economy should lift everyone, not just those at the top. By combining financial acumen with a commitment to social good, Buffett sets an example of responsible capitalism. For him, success means not only building wealth, but also making a positive impact on society. Warren Buffett's strategies offer valuable lessons for anyone looking to master the market. His focus on long-term growth, patience, and understanding the fundamentals of each business has proven successful time and again. By ignoring short-term economic predictions and staying within his circle of competence, Buffett has shown that simple, steady strategies can lead to substantial success. For aspiring investors, the key takeaway is to focus on quality over quick gains. Look for businesses with strong fundamentals, avoid getting swayed by market noise, and be prepared for both good and bad times. Building wealth takes time, and Buffett's approach reminds us that there are no shortcuts to investing. As you think about your own investment path, remember Buffett's principles. Be patient, invest in what you understand, and keep an eye on the long-term picture. By following his example, you can build a more resilient portfolio and approach the market with confidence.